Hello and welcome to the lecture for week 3. In this lecture, I'm going to talk about adjusting journal entries in general and discuss the concepts and guidelines that direct us as to how to do adjusting journal entries. And then I'll talk about several different categories of adjusting journal entries and provide some examples for those. So we talked last week about steps 1 through 4 in the accounting cycle, about identifying and analyzing transactions to determine what categories and what accounts were being affected and how to increase those with either debits or credits. We talked about how to record those transactions in a general journal through journal entries. We next talked about how to post journal entries to a general ledger so that we could summarize all of the impacts on each specific account. And then lastly, we prepared an unadjusted trial balance. So that's where we left off last week, and we're going to pick up at that point. So today we're going to talk about adjusting journal entries, and next week we'll talk about posting those adjusting journal entries to a general ledger, preparing an adjusted trial balance, and preparing the financial statements. We'll do steps 1 through 7 every single month, and then at the end of the year, we'll prepare closing entries and a post-closing trial balance. And we can ignore reversing entries at this point. So in talking about adjusting entries, I want to go back to one of the things I said in the first week that we met, which is that accounting is storytelling. We want to tell a story to decision makers about what happened in an organization over a period of time. The closer we can come to telling the absolute truth without errors and without bias as to what happened in that period, the better able decision makers are going to be able to make sound decisions and guide the organization. So adjusting entries are a critical process in that. It's really in many ways the difference between bookkeeping and accounting. Bookkeeping is recording the transactions that flow through the organization. Accounting is then making the adjustments to those transactions, how they've been recorded, to more accurately tell the story. As an example, if I bought a year's worth of supplies in January, I wouldn't want to record that as an expense in January. It would distort that month, make it look worse than all of the other months, when in reality, we're using those supplies all year long. So that's an example of how we can create adjustments that more accurately reflect what happened in that business. So adjusting journal entries are based on some of the concepts that we've already discussed in this class. So I want to review them just briefly. The first concept is the economic life of any organization is divided up into what are really artificial time periods: fiscal years, quarters, months, so forth. So when we divide time into periods like that, it becomes very important which side of each of those deadlines we record an entry on, or how we apportion an expense between multiple different periods. We'll talk about that today. The revenue recognition concept is also important. We want to recognize revenue when we provide the product or service to customers over the period in which we do that, not when we get the cash before we do the project or afterwards. The matching principle is closely related to that. We want to recognize expenses not in the period in which we pay for them, or necessarily the period in which we get the invoice, but we want to recognize expenses in the period where those expenses match the revenues to which they're related. All of those three principles together form the basis for accrual accounting, which is recognizing revenues when earned and recognizing expenses when incurred or when associated with the revenues that they are connected to. Small businesses, say you do a lawn care business on the side, those businesses can use cash accounting, which is we recognize revenue when we collect the cash and we recognize expenses when we pay cash. So small businesses can do that, but business of any size, in order to be consistent with accounting principles, need to use accrual accounting. And adjustments are really the basis for accrual accounting. So accruals, and well, let me first talk about the adjusting process. So the adjusting process is analyzing and updating accounts at the end of a period. And we do that before the financial statements are prepared. We do it to get expenses and revenues in the right place, to get items in the right place on the balance sheet, as well as to correct errors that we may have found in the process. And those would be correcting entries, not necessarily adjusting entries, but have the same effect. So why do we make adjustments? Well, some expenses aren't recorded on a daily basis. For example, the consumption of supplies. If I didn't stop and count supplies and make an adjustment, when would that happen, right? Nothing is going to trigger that entry other than us knowing we need to do it. Some revenues and expenses are recorded as time passes rather than as separate transactions, which means I might pay my insurance in advance. All of us pay for car insurance in advance, as an example. I pay for that in advance. Well, it becomes an expense as time goes by. And then some revenues and expenses may be unrecorded if we don't make an entry. Say, as an example, we've mentioned many times in this class that people have worked for us. Payday isn't until the following month, so there's no transaction that's going to record payroll in this month, but we need to recognize we've incurred an expense. People have done work for us, and we have a liability. We owe them money. So if we don't make the adjustment, if we don't record that adjusting journal entry, then that would be unrecorded in our books. So the words accrual and deferral are words that we don't use in everyday language, so I want to just kind of give us a different way of thinking about them. Deferral, another word for that is delay. So we might spend cash, as an example, on supplies now, but I don't want to recognize the expense now. I want to delay the recognition of the expense until I actually use up the supplies. I might pay for insurance now. I want to delay recognition of the expense until time has gone by and I've used up the insurance. The same thing with revenues. I might get paid in advance by a customer. I want to delay recognizing the revenue until I actually perform the work. Accruals are the opposite of that. It's where action has taken place and the cash is going to happen later. So I've done some work for you and I want to recognize that you owe me some money and that I've earned some revenue. I need to add that to my books in order for my accounting records to reflect that. You have worked for me, but payday has not come yet. It's not going to come until later. I need to accrue that to add that expense to my books. So I'll first talk about deferrals and we'll do some practice problems with those, and then I will talk about accruals. So deferrals are assets for which advance payment has occurred before the company can benefit from that use. So there's two different categories. There are prepaid expenses and there are in effect prepaid revenues, which we'll call unearned revenues. So prepaid expenses, there's a couple of different kinds. One is supplies. We've talked about that a number of times. Another is prepaid expenses. So those are any expenses that I pay for up front and then they become expenses over time. That might include insurance, as I've mentioned. It might include rent. It might include advertising. There could be a variety of expenses that we pay for up front. And then depreciation is also a form of a prepaid expense. So we'll talk about that a little bit as well. And then lastly, I'll talk about unearned revenues. So prepaid expenses, it could happen one of two ways. It could happen either as time goes by or as some physical consumption registers an expense. So when I pay for my insurance up front, in this case I pay for a year's worth of insurance, I spend $2,400, so I debit an asset, prepaid insurance. If I sold my business the next day, that would be an asset that would be worth something to somebody. The insurance has already been paid for, they don't have to do that. So I debit an asset, prepaid insurance, and I credit cash. Another example, as we've mentioned a few times, is I buy supplies. So I debit supplies and credit cash. Now, over time, I'm going to record an insurance expense each month, and I'm going to reduce my prepaid insurance each month. So as time goes by, I transfer cost from that asset to an expense. At the end of 12 months, the balance in my prepaid insurance account should be zero. The same goes for supplies. As I use supplies, I record an expense and I reduce the asset. So go ahead and do, in your in-class practice, pause this and do EA5 and EA8, and then check it against the solutions. So depreciation is another way of thinking about a prepaid cost. If I need to make deliveries all over Thurston County for my business, I might buy a step van, and I might use that, or a Sprinter van. I might use that Sprinter van to make deliveries everywhere. I buy that Sprinter van today, and I'm going to use that for the next 4 years. So in a way, I'm paying today for the use of a vehicle that I'm going to use over the next 4 years. I'm going to wear that vehicle out. I'm going to put a lot of miles on it, and it's going to be worth less when I'm done with it at the end of 4 years, probably substantially less. So I'm going to record that drop in value, in effect, as using up part of that asset. And I'll do that through depreciation. So depreciation isn't intended to be a way of trying to determine a value of an asset down the road. It's a method for allocating the wearing out of that asset over the life that we intend to use it. So determining the depreciation expense is based on 3 different factors. One is the initial cost of the asset. That's all of the costs associated with me getting that asset and getting it ready to use for my business. In that example of a Sprinter van, I might buy the Sprinter van from a car dealership, but then I need to buy some racks to put in the back. I need to maybe buy some artwork that I can put my company's logo on the side of the van. I might need some kind of computer in the van to help direct where deliveries are made, that sort of thing. So there might be expenses other than paying for the van that I also need to incur. So it would be all of those expenses together would represent the initial cost. Then I need to estimate what the useful life is. And it's not how long do I think that Sprinter van in that example is going to last. It's how long do I intend to use it. So if I intend to use it for 4 years, maybe it'll actually last 10 years or longer. But I only want to use it for 4 years, and then I want to get a new van. So I would depreciate it over 4 years. And then lastly, I estimate what the residual or scrap value is. So what is it going to be worth at the end of the 4 years I intend to use it? So the formula for that, and this is straight line, there are other methods for depreciation, but most organizations use straight line, so that's what we'll focus on. The annual depreciation is the cost minus the residual value. That's called the depreciable cost, or how much it's going to go down in my estimation over the period of time in which I'm going to use it, and I divide that by the useful life. So in this example here, I have a $24,000 machine, $2,000 residual value, and I allocate that over 5 years. So I take depreciation of $4,400 each of 5 years. So when I record the annual depreciation, I do that by debiting depreciation expense, and I credit an account we haven't seen before called accumulated depreciation. Accumulated depreciation is what's called a contra account, meaning it has the opposite balance of its neighbors. So this account, accumulated depreciation, is going to appear on our balance sheet right after the asset that's being depreciated. So I might have an asset called delivery van, and my accumulated depreciation for delivery van would be right below that. So delivery van as an asset, we all know, has a normal debit balance. Because this is a contra account, it's going to have a normal credit balance. So we credit accumulated depreciation to increase that account. One concept to be aware of is the book value of an asset. So the book value of an asset is the original initial cost of that asset minus its accumulated depreciation at any given point in time. That gives us the book value. That's the net value that's on our balance sheet for that asset. That becomes a meaningful number if we dispose or sell that asset. That would trigger us to potentially have to record a gain or a loss when that happens. So the next topic, unearned revenues, is sometimes a bit tricky for students. This is when we are paid in advance for work we have not done yet. Okay, so that generates a liability. and that liability is going to be called, and this you see here, unearned rent revenue, unearned fees. Unearned is going to be part of the name of that. And it's a liability. The reason it's a liability is if, say, I receive an advance rent, which is shown here, I get $360 cash. Somebody's going to rent some space from me for 3 months. They haven't occupied that space yet. Nothing has happened. I haven't done anything other than receive cash. I haven't earned that rent revenue because they haven't occupied the space. So if they turn around and decide, now we don't really want the space after all, or I decide I don't want to rent it, I need to pay them back the $360. So I owe them that money until I've earned it. The same would be true in the example below where I get fees in advance. Somebody pays me $1,000 to do work for them. I'll debit cash and I'll credit that liability. Because again, if I decide I don't want to do the work or they don't need it, I owe them the money back. As I earn it, I will reduce that liability. So as either time goes by or as I do work, I'll record an entry where I reduce the liability with a debit. So I debit unearned rent and I recognize that I've earned my rent revenue now. Time has gone by. Or in the bottom example, I've actually done the fees, or I've done the work to earn the fees, and so now I get credit for that. So go ahead and pause the video and do in-class practice EA6 and take a look at the solution. Next, I want to talk about accruals. So accruals are types of adjusting entries that accumulate during a period where amounts were previously unrecorded. So again, if I don't record them, they wouldn't be recorded. And we'll talk about two different kinds, accrued revenues and accrued expenses. So one form of an accrued revenue is just what I show here, where I've done work for somebody, I haven't invoiced them yet, they haven't paid me yet, but I want to recognize at the end of a month that I've done some work, they owe me the money, I need to record some revenue. So I have an example here where I'm debiting accounts receivable. Debiting accrued receivable is actually probably a better way to do it, just so that I don't commingle accounts receivable with amounts that I haven't yet billed a customer. So accounts receivable maybe should be for amounts I've invoiced, and accrued receivable would be amounts that I have yet to invoice, but I've done the work. Interest receivable, if I've loaned money to somebody, I'm going to earn interest as time goes by. So the formula is going to be the face amount of the amount that we've loaned somebody times the interest rate times the length of time divided by 12 months. So this becomes very important if we have a loan that spans over a year end. So say as an example, I loan somebody $10,000 at 6% for 9 months, and I do that on October 1st. Well, I need to stop at December 31st and say, okay, well, this person, I have now earned some interest on this loan. So I need to say 10,000 times 0.06 times 3 over 12. So I need to record interest up to that point and record interest revenue. So I'll record interest receivable, I'll debit that, and I'll credit interest revenue to show I've earned that money. Then at the end of the loan, I'll record the other 6 months. So when the loan matures at the end of the next June, if I remember correctly, I'll record the remaining interest for that period. And then, of course, the debtor pays me and I receive cash, which includes the principal and the interest receivable at that point. So the same is true when you go to the other side of the table and you borrow money. You owe interest. And so if, again, we borrow money and that loan spans over the course of a year end, at December 31st or whatever our fiscal year end is, we need to stop and say we've owed this money. We also owe some interest at this point, and we need to debit interest expense and credit interest payable to recognize that over that period of time. Another type of accrual that is done for corporations is income tax payable. So we'll take our pre-tax net income, multiply that by whatever the relevant federal income tax rate is for corporations at that time, and we'll record income tax expense and an income tax payable. So that's an entry that if you were doing this for a corporation, you would record. And then finally, we've done this entry many times, salaries payable. So we look at our payroll records, who has worked how many hours, what are their wage rates as of the end of the month, and we record that we've incurred a salary expense. So we debit salary expense to increase it, and we recognize that we owe those employees money, so we credit salaries payable. This is done for the gross wages that are earned, not net after deductions. So I hope that makes sense. So please stop now and do the in-class practice EA7 and then EA10 and EA11 and compare that to the solutions. Finally, what needs to be done for next week? Complete the homework assignment for week 3, which is pretty straightforward, and then take a look at sections 4.3 through 4.5 before next week's lecture. So as I mentioned before, we're going to talk there about posting common adjusting journal entries to the general ledger, preparing a trial balance, and we will prepare some financial statements next week as well. So please take a look at that. And thank you very much for your time. I look forward to talking to you with the next lecture.